welcome to Geared for Growth. I'm your host, Mike Mortlock, Managing Director of MCG Quantity Surveyors. Today, a special treat. We have a long-time listener of the Geared for Growth Property Investing podcast, also a client of our business, MCG Quantity Surveyors. We've got Brendan Colley. Now, Brendan works as a financial guru, not connected to the property space, but why I'm so excited about this one is we get to hear about how he got his start investing in property to the point of having a multi-property portfolio, and he shares his values, his equity position, the mistakes that he's made, his transition from residential to commercial, and some great advice for property investors wanting to get started, great advice for time poor people, and great advice from an aspect of planning, of risk analysis, and overall strategy. It's a really great interview with Brendan, who's a very, very clever person who's had some great success in property investing and is still in the middle of his journey. So looking forward to checking back with him. But here's Brendan. Brendan Colley, thanks for joining me on Geared for Growth.
Mike, thanks for having me on.
Well, I should thank you with much more enthusiasm, because this is an episode I've been looking forward to for quite some time, because you're not necessarily an industry person. We're getting actually more of a perspective from an investor's side of the fence. So it's probably not unprecedented on Geared for Growth, but in the last 8 years, I think we've been doing this. It's predominantly talking to buyers agents and accountants and mortgage brokers and industry people about what advice they can give to property investors to further them along in their journey. But the focus for today is really you as a property investor. You've been investing for around about a decade. Full disclosure, you've been a client of ours as well, but it's not necessarily about that. It's about what you've actually been able to do with property. But before we talk about your property investing journey, I want to talk about your job, because I feel like that's relevant to the story as well, because with your background and your expertise and your experience, it wasn't necessarily property is the way to go. You had other opportunities. So can we start there, Brendan?
Yeah, sounds great. So I work as a senior associate for an organisation called the Queensland Treasury Corporation, and we help the Queensland State Government with various bits of client advisory work. So my education background is in accounting and finance. I did a commerce degree at the University of Queensland, and have worked here for close to 10 years, helping state government agencies and clients.
Yeah. So, with that degree and with your experience, it's not necessarily that property is the way to go. With that sort of background, you would think, well, traditionally you might have more of an interest in the stock exchange or some other form of investing. But what was it about property that got you excited in the beginning?
Yeah, it was largely the concept of leverage. Before I bought property, I owned managed funds with margin loans through NAB, and used to run a managed fund portfolio at about a 40% LVR, or loan to value ratio. And once I'd experienced 5 or 6 years of investing that way, I realized that property was a vehicle that was a scaled up version of what I was doing, and the ability to access, say 90 to 85% of the value of an asset via the bank's capital meant that I realized that any movement in asset value meant that I would be able to get a really good cash on cash return, or a really good return on equity. And that meant that I was attracted to that.
And I would say that's a fairly atypical investment style. Most people that are investing in managed funds or the stock exchange wouldn't necessarily even be leveraged to that amount. Is that fair to say?
Yeah, it is. I wouldn't say that I was common in having leverage against equities or managed funds. It definitely helped that, especially after the GFC. A lot of the people, some people lost their shirt in terms of the GFC, doing exactly what I did a few years later. At the time, Australia was in the end of the mining boom. We were cutting the cash rate to try and stimulate the economy and increase employment. And I had a hypothesis that people would take money out of term deposits and invest that into blue chip equities. And I doubled down on that view, say from around 2013 through to 2019. And then once I sold my managed funds, I decided it was time to scale up into property investment.
Now, you're obviously a clever guy, so my job as the host is to keep you relatable, because you are a little bit cleverer than average with your background and your expertise. But with that foundational financial knowledge, it didn't necessarily make you a genius property investor. So I'm keen to know, what does the portfolio sort of look like today, and how do we sort of get to that point? And was it an easy sort of linear progression to get to where you got to, or were there some bumps along the road?
There are definitely plenty of bumps. We'll get into those shortly. So at the moment, my wife Sally and my portfolio sits at around 3.1 million. Of that, we have debt against that of around 2 million. So an LVR of just a bit under 70%. And it consists of 2 residential properties and one commercial property. We bought the resi properties, one in 2019 and another in 2021, and then we bought the commercial property in 2022. So I would say that our portfolio got kicked along, perhaps luckily by COVID, in terms of at that stage we had the one asset and we weren't quite sure what was going to happen. But I guess with the fiscal stimulus, that meant that, and cutting of the cash rate meant that people's borrowing capacity improved, and we got that equity uplift.
You and everyone else that owned something during COVID. I mean, basically the whole of Australia, you could have had anything and it probably would have gone up in value. Talk to us about the decision behind that first particular property. Obviously, you mentioned that you wanted to get into the property because of the ability to leverage that is, greater than normally any other asset class. But there's a big jump from going property to, I'm actually putting an offer on XYZ street and suburb.
Yeah, so to be honest, I was fairly petrified before I bought my first investment property. I'd always seen a mortgage as something that was quite restrictive, and it took me a fair while to get past that mindset. The actual asset that we got, we used a buyer's agent to help us, or to help me pinpoint where in Brisbane, and I live in Brisbane, for disclosure, and I at the time, the Cross River Rail and a few other major infrastructure projects had been approved, but not yet started. So I suspected there was going to be quite a lot of jobs in the broader city, and that kind of underpinned my confidence to invest capital.
Yep. And so, what were we talking? House, unit? What sort of price
point?
Yeah,
it's a 4-bedroom house. I bought it for $450,000 back in 2019.
Wow. And what are we talking in terms of value today compared to 2019? Because that's fast approaching a stamp duty cost rather than an asset price.
Yeah, I mean, at the time, it definitely felt like a lot of money, and it had kind of stretched my capacity at the time, but it's worth about 900 now. So
yep.
We've been able to use the equity from that asset it contributed to the deposit that we put down on the commercial property. The second property we bought, which was residential in 2021, we paid a cash deposit for that, so we didn't use the equity from the first property.
Yep.
And we bought it for $515,000 in May of 2021.
Yep. Brisbane as well? Or?
Yeah, it was Brisbane as well. We decided that the eastern suburbs, or the eastern kind of region, which is kind of the Redlands Council, it was more affordable at that time, which meant that it made it easier from a borrowing perspective, but also just where I thought there was probably room for growth, given that it hadn't grown to the same extent that areas on the north side and Southside had.
Yeah, and I think you probably have been proven right. And I've just got the index results for CoreLogic for December on my desk at the moment, and Brisbane's done 11.2% in annualized growth. Third only to Adelaide by a couple of percentage points, and Perth, which is obviously the big elephant in the room for 2024. So you've done very, very well. In terms of the strategy that you had, is there a strategy today? Was there a strategy for the first one? Was it an idea of, this is where we want to get to, this is the amount of equity that we want to have, this is the passive income I want to enjoy by X amount of time? Talk to us about that.
Yeah, it's a good question. I wouldn't say that it was as planned out as what it perhaps should have been. It was. I knew from probably the time I was 15 that I always wanted to build wealth, and it became clear to me that property was a way to get leverage to increase the return on equity more quickly, which we previously spoke about. The strategy was always to build equity in the first asset, use that equity to compound into other assets, to be able to not have to put as much cash down and generate an engine, so to speak, or to I guess grow the portfolio. The goal for us, and part of the reason that we invest in property, is there's three main reasons which I'll touch on quickly. One is a bit of a probably selfish goal, which is around wanting that financial independence to use our time how we like with the people that we choose to, and to do whatever type of work that fulfills us. The second one is around philanthropy, and I've got goals in the future of setting up funds that spit out an annual annuity that can contribute to sporting and education scholarships for kids who perhaps come from disadvantaged families. And then the third main reason, which is I'd call intergenerational, so it's taking a long-term view of our kids and grandkids, as well as nieces and broader family, to set them up in a way that they can understand the value of money, but also to be able to make the best impact in the world.
Yeah, beautiful. I mean, very admirable reasons for doing it. So you mentioned with that strategy, the idea was you get the first investor property, use the equity to buy the next one, and so on. But you actually didn't do that. You used cash. So obviously you were in a position where you were able to do that with savings. But why did that strategy change? Because you could have kept that savings and probably used the equity, or was it in a situation where there wasn't quite enough equity, or how did it inform it?
Yeah, it was. We could have used the equity, and potentially with a bit of extra knowledge now that may have been a better decision. But I've always, I guess, at university, I got taught a really important concept, this is not something that you have to go to university to know, but it was just a term called an opportunity cost. And
Yep.
And the opportunity cost of us not using cash on the second investment property meant that it would be sitting in our bank, not earning a great deal.
Yep.
And that wasn't acceptable to me in terms of a use of capital. I wanted that to be an asset that could generate a higher return on equity. So as investors, there's this bit of a fine line we tread between having enough cash to be able to have those buffers in place for financial and personal emergencies, as well as maintenance and things that come up with properties, but not having too much cash that it's not being put to its maximum use, or it's not working as hard as it potentially could be. So I felt at that time that we had surplus cash that it needed to get deployed into another asset.
Yep. And then, of course, I suppose the unintended consequence of that better use of the capital is that it also changed your proposition for the next one. And I'm interested in how that came about strategically, because you went from residential to commercial, and it's all property, it's all real estate, but very, very different types of real estate with different rules, different considerations, different types of due diligence, and different drivers of return, whether it be yield or cash flow. What made you take the jump there?
Yeah, it was me looking longer term to what would potentially delay the growth of our portfolio, and some of that was, so both our residential properties are negatively geared.
Yep.
At the moment with higher financing cost in the order of kind of 10 to 15 grand a year. So let's say a total of around 30K. The concept or the idea of continuing to use equity to buy another residential property, I could see that, whilst our portfolio would be larger and therefore we would have a larger asset base to earn equity on, it would also mean another cash, draw on my wife's and my income. So I looked at that strategy as being less scalable to buying commercial, where we could get a 6% net return compared to, say, a negative 1% net return from a cash perspective with resi, to help the portfolio self-fund itself. That was the strategy. It was how do we scale, but also in a way that means the portfolio isn't drawing on my wife's and my income as much.
Because there's two parts to that, I suppose. There's one, can we service that as a family unit? And the other part is that, well, how is a financier going to look at us as an investor prospect if we are servicing a third negatively geared property? Was that sort of part of the mindset as well?
Yeah, it was. And I was lucky to have some advice and mentor from more experienced investors who I'd heard talk about this exact kind of problem. As people are trying to scale a portfolio, they run into serviceability constraints with banks, and that partly just comes down to, because property is great in terms of being able to leverage and get money from a bank, but it's not as productive as perhaps I would like it to be from a cash flow perspective. Yep. So you end up with this scenario of carrying debt against an asset that doesn't generate enough cash to always fund that debt as much as you might like.
Yep.
So that was the strategy, was how do we buy an asset that won't require as much cash from our personal jobs,
yep,
and will help us scale kind of sustainably in the future.
Yep. So tell us about what the end result was. What sort of commercial property did we look at? What sort of price point? Did you get that net 6% yield? And I was going to throw in another question, but I think probably 3 or 4 in one go is enough.
No, that's right. Yeah, happy to talk about it. So we bought an industrial warehouse in a place called Bethania, which is in kind of southwest Brisbane. Mm-hmm. The intent wasn't always to buy in Brisbane. It was just a deal that came up, and that purchase price was 1.16 million. It is a 426 square meter shed that's currently used. The tenant is a high-end fishing manufacturer.
Oh yeah.
Who manufactures kind of high-end fishing equipment that goes onto boats and etc. But that we bought that property using equity from the first 2 residential properties,
yep,
plus a commercial loan, which meant that the property was 100% financed. So that's not something that everyone is potentially prepared to do. It meant that we had a bit of a cash draw just for the first kind of 2 years while before the rents have increased. But yep, now we're in a position that asset's funding itself, and we've got the extra capital in the market.
Yeah. So when you say 100% funded, I guess you're sort of technically looking at the fact that if you're using equity, then you're almost like reborrowing from those original assets. But from a LVR point of view, how much of that deposit had to come from your pocket? In another word, the equity of it.
Yeah, so we put down 20%. So had a 20% which came from extra borrowings from the residential properties, and then
yep,
then there was a commercial loan which represented 80% of the value of the asset.
Now that is atypical in terms of commercial property investing. We always kind of hear that you sort of need like a 40% deposit, or, a lot of places will do a 30% deposit, but you don't commonly hear about 20% deposit. So I'm guessing the devil might be in the detail in terms of that commercial loan. Were you forced to pay a slightly higher interest rate because of that LVR, or was it sort of inconsequential?
No, we definitely paid a higher rate for that lower deposit, and completely agree with what you've said about commercial generally. I would say that some specific commercial properties, which might be, say, daycare centres or medical centres, banks will only lend up to a certain percentage because they're bespoke type of assets.
Yep.
In our case, because it was industrial, they're perhaps got and we went with the second tier lender, so they were more willing to lend us more to be able to purchase the asset. But since the asset's grown in value, we've since refinanced and
I was just about to say, I mean, that's always the option. If you're paying a higher rate to get in, or you're using a second tier lender, then it's the trajectory to being able to refinance with a lower rate or something like that. I'm interested in this particular property. You said it's gone up in value, but you did mention that the rents have gone up. Is that the majority of the push to the increase in the value? Because we know the way that commercial property is valued is a little bit different to residential. There's much more sort of focus on the capitalization sort of method in terms of the return of that asset rather than market comparables, because I guess the data is not as rich for comparables in industrial warehouses in that suburb as it is, your average residential property in a city. What was the reason why it went up in value?
The Geared for Growth Property Investing podcast is presented by our business, MCG Quantity Surveyors. If you're an investor or a property professional looking to get the best tax depreciation deductions for yourself or your clients, please get in touch with us at mcgqs.com.au. It's our mission to help as many property investors as we can to maximise their claims and maximise their property education as well.
Yeah, exactly as you've just described. So as the rent increases in any commercial property, so commercial property, just for people who may not be familiar with it, it's generally the asset value is a capitalization of the income, and that just means that the income is divided by a return that's considered acceptable in the market. And so in our scenario, it was around $90,000 worth of income getting divided by a capitalization rate or an acceptable net return of around 6%. Kind of gets you to around 1.4 million or a little bit above that, which was, it's a different way to think compared to valuing residential property, which is generally based on comparables of looking at properties that have sold from down the road or within that 1 to 3 kilometre radius. It's mostly tied to the income that the asset can generate.
And with that rental increase, was that by virtue of market comparables dictating that it was underdone and the lease came up for renewal, or was it part of a lease term that you were getting 3% or CPI increases? How did that increase actually happen?
Yeah, so it happened as a result of a negotiation between the tenant and I, we wanted a 3-year lease, but he only wanted a 1-year lease, and that meant, so because of that shorter lease period, I said I'm happy for you to stay, but we want a larger increase in rent to compensate us in terms of not having that longer lease. So you could argue that he's probably paying slightly above the market right now because of that shorter lease period that he entered into. But generally, in most commercial property leases, you'll see a rent index clause, something along the lines of, rent will increase either either in CPI or 3% or the higher of either. So that would be a really common term that you would see, I guess, in lease contracts.
Yep. And when it comes to the due diligence with the residential compared to the commercial, how would you contrast the two? And are you in a position now where you're sort of thinking, well, residential or commercial, it's got to serve what I need in my portfolio? Or are you actually thinking, well, now I'm a commercial guy, or I hate commercial, I'm going to go back to resi?
No, I am a little bit on the fence still, to be honest. So I look at both asset classes, and I think they serve different purposes. So I'll just get into that. I'll answer your first question, which is around the due diligence. I would say there's a lot less risk in residential investing generally compared to commercial investing, as long as, and one of the points I'd written down before we met was just for people to consider that, high land to asset ratio in terms of making sure that the property's got good fundamentals and isn't characterized by, I guess, people who are all similar. So sometimes you'll see in a house and land package scenario where a developer might split up a lot of lots, and then you get a lot of the same type of demographic move into one area. That would be something that I'd want to avoid. In terms of the due diligence for commercial, it's largely around similar to resi in terms of the vacancy rates, but also making sure that the rent that the tenant is paying is reflective of the market rate. So, for example, because the asset price is a capitalization of the income that we described before, if a tenant is paying above market rent, that will get reflected in the asset price. So it's really important for any commercial investors to make sure that a property that you're considering, that the rent being paid by the tenant is in line with the market, because if it's above it, then potentially the agent or the vendor could be chasing a higher price than what it's worth.
Yep. Now, just changing direction for a second, you would, I assume, identify as a time-poor professional person. For people in that situation that are interested in investing in property, what would be your advice for those people that maybe don't necessarily have a huge amount of bandwidth but want to make sure that they're making the right decision? You mentioned yourself, you were kind of worried about that first particular one, and there was a bit of trepidation with getting your toe in the water. Like, what advice would you have people in a similar situation?
Yeah, I would say that before you even look at property or are thinking about property investing, it's having a bigger vision for what you want in your life. So understanding what goals you have for in decades down the track. I am someone who's lucky to think long term almost by default, and my wife kind of balances that out by helping me stay in the present. So I'd say be very clear about why you want to invest in property. A second point that I've written down is play to your strengths. So some people, whether they're they might be particularly good at maths and might be able to use Microsoft Excel, in which case you could probably answer some questions yourself without having to rely on others as much. Or if you're a tradie or someone who works with your hands, you could be really good at doing some cosmetic renovations yourself. So it's telling people to play to your strengths and understanding where you've got gaps. So if like me, I'm an accountant, I'm useless on the power tools, so I just outsource all of that. I kind of recognize where I'm good versus where I've got weaknesses, and I would say check the credentials of experts that you plan to work with. Mortgage brokers, accountants, buyers agents, property managers, quantity surveyors, building and pest inspectors. There needs to be a level of checking people's credentials and experience, but also at the same time, don't get stuck in a perfectionist mentality where at some point you have to make a decision and trust people. And I've been lucky that for the most part, that's worked out really well for me.
Yep. Sorry, go ahead.
Oh, sorry. I just had one other point that I wanted to throw in there before we move on to the next one. But I'd say a trait that's helped me is just to always be learning. So regardless of your portfolio size, or whether you don't have any yet, or whether you have a number, it's to always be kind of hungry for knowledge. I've kept learning. I still listen to the Geared for Growth podcast, as much now as I did before I bought the first one. So there's ways to learn from people, and it's just been hungry to continually improve.
Well, I, for one, very appreciative as a long-time listener that you're coming back to give back to the community that hopefully has helped you a little bit along the way. However, you sort of said it's been fairly plain sailing, but you mentioned in the beginning some pitfalls. So whether it's something that you've experienced directly or not, I'm interested in your thoughts on what to sort of look out for a property investor, and where you think you can see people going wrong. I know you're an active participant in the property forums, property investor forums. You network with people really well in the space to further your knowledge and to give back to others that are just starting. So I'm really keen to hear your thoughts on that.
Yeah, I would encourage people to get as much free education as you can, largely via podcasts. So a couple that I've listened to diligently from the time I first started was Geared for Growth. Shout out to Mike and appreciate that. The Property Couch is another one. I've really enjoyed the content that those guys have put out. In terms of pitfalls and property specific ones, I would say so. Property is an unregulated kind of market, and what that means for the average person is that the government doesn't regulate so-called kind of property experts the same way they do in other professions like accounting or engineering or lawyers or doctors. So what that means is you have a lot of people who perhaps don't have your best interest at heart as much as they do their own income statement. So that just means that a person who's wanting to purchase advice or expertise needs to be really diligent when checking the people that they're planning to work with, which I mentioned before. I would say that people should avoid, as I've already said before, kind of avoiding properties or assets. So generally I have a preference for standalone houses because I prefer the land content, but there are times where townhouses or apartments of a certain type would make sense. So if I was buying a townhouse or an apartment, I'd be looking for one that has got a high land to asset value. So that might look like a smaller apartment block, say like a block of 8 versus a block of 30, or it could be 20 years old and it might not have a lift and might not have a pool, so to speak. So it's probably a little bit more no frills, but has a high land value relative to the asset price compared to say a newer high rise that has a gym and a pool and a lift, where a lot of the value of what you're paying is going into a depreciating property.
Yeah, no, good advice. And when you sort of say 8 versus 30, I mean, you could expand that to the ridiculous. It's 8 versus 300, right? Because that's a viable option out there for property investors. And I think you and I have probably both seen and heard all sorts of horror stories of people buying that sort of asset. But I mean, there is a very strong argument for the moment for units just because of affordability constraints. And if you can get into one of those smaller blocks, you still have a reasonable land asset ratio, right?
Yeah, definitely. And for some investors, that 100% makes sense. If I'd grown up in Melbourne and kind of lived my life around various apartments, like it would feel very normal to purchase an asset like that, or inner Sydney. So just one other last point I'd make on in terms of pitfalls that investors or people potentially considering investing, it's just having a short-term mindset. So I, for example, wouldn't want to purchase an asset and hold it for probably any less than 5 to 7 years.
Yeah.
And the reason for that is, you pay stamp duty up front, which is considerable. You pay agent fees. So when you sell an asset, you also pay capital gains tax. And if the property is negatively geared while you own it, you're going to pay a cash deficit for each year that you own it.
Yep.
So you need to be able to hold the property for long enough to recover all of those costs once you do sell it, and that just requires time. So I just encourage people not to buy a property or invest in property with a mindset or attitude that we might sell this in kind of 3 to 5 years, because depending on where the market cycle is and where you've purchased, there's a chance that you might not recover all of those costs, and then it ends up arguably being it ends up being a valuable lesson for that investor, but it's probably not the best use of time and money.
And I suppose you can run that as your own Excel experiment. You realize if it costs you, let's say $40,000 to get in with your pest and building and your stamp duty and all of those establishment costs, if you've made 100 grand in 12 months, or let's say 500 grand in 5 years, as a percentage of the gain, those upfront costs become smaller and smaller. So I think that's one of those ones where you can actually sort of model that yourself and see the difference. Now, you mentioned in the beginning, from a young age of 15 or thereabouts, you knew you wanted to build an asset base, but you also kind of admitted at the beginning you didn't have a perfectly well set out strategy, or let's just say you could have had more meat on the bones from the strategy. It's making me thinking about the back end. Now, you're still a young man, but every sophisticated property investor should have a good strategy, which includes a strategy on exit. Now, maybe if you're still in accumulation mode, then that is a flexible strategy, but there should still be an idea about, okay, well, what is that exit strategy? Is that something that you've thought much about? And if so, let's hear it.
Yeah, I have. I mean, in preparation for today, it was a good way to think about it. So we currently rent vest, so we don't live in our own primary place of residence. We will likely continue to do that for at least I'd say the next 10 years. So we have one daughter, and we're also expecting twins, so that helps keep things pretty busy at home. But the reason for that strategy is to be able to preserve our borrowing capacity and continue to at least maintain our current asset portfolio, or ideally grow it as well. I can see a fork in the road in probably the next 10 years where we'll be faced with a decision as to whether to sell an investment property, realize a capital gain, and then there'll be a choice about what to do with that capital, whether we use that to fund our own PPOR, with hopefully minimal debt, or whether we pay off some investment debt to create an ongoing passive income.
Yep.
So that's the decision that's we need to get clarity on, now that we'll probably have to make in, say, between 5 to 10 years time from right now.
Yep.
As our kids get older. But ideally, I would like to hang on to all assets and build up a deposit for a house, via cash savings.
Yep.
Because it'll mean that we can preserve our investment portfolio for the kids and for those other goals that we have around philanthropy and giving back, as well as have that stability of somewhere that's ours that we don't have to move from. So
yep.
We at the moment, in 20 years time, ideally the portfolio size, and I've modeled this out in Excel, and the numbers can start to get a bit silly when you spit it out by kind of decades, but by the time we're 50, we should be in a position where we can sell some assets and either own our home outright, or if we continue to rent, that'll be enough money that we'll have a passive income, somewhere in the order of $100,000 to $200,000 a year.
Yep. Yeah. Awesome. And I neglected to ask before, after the commercial one, did you get to the point where the portfolio is approaching neutral, or is it slightly positive? And if you have modeled it, like, when does it go positive?
Yeah, so it's slightly negative at the moment,
Yep.
but not by much. It will go positive next year, which will be nice. Even despite higher financing costs. So if interest rates come down this year, it could potentially go positive as a whole portfolio sooner.
Yep.
But yeah, that will definitely take some of the pressure off. So in terms of probably, do we have time to talk about kind of mistakes
Go for it. Yeah.
some things
Go
that
for it.
some things that have come up that I would, to give people full clarity on. In our first house, we had to fund a $40,000 retaining wall repair or replacement. So
Yep.
I think our initial deposit into that house was $54,000 back when I bought it in 2019, and then we had to spend about $40,000 to replace a retaining wall. So check retaining walls before you purchase assets.
Mm-hmm.
I'd say and then financing costs. So I mean, I was lucky. I had modelled out what kind of buffer we could withstand. If the cash rate was to increase, which happened last year, and the last 12 to 18 months have definitely been tighter from a cash perspective. But at no point have I been worried that where we would be in a position to have to sell assets. It's just doing your modelling around that to make sure if rates were to increase, or if they were to stay higher for longer, kind of how long would we be able to hang on to the asset.
Yeah, excellent. And I suppose that's a cautionary tale for people that aren't going to that level of analysing it. And of course, you've got your finance background, and try stopping you from modelling things out like that. But a lot of people don't necessarily consider the fact that if interest rates go up and they're not on a fixed term period, then that can really affect the health of their household cash flow, right?
Yeah, and it kind of links to another point that I mentioned before around that. I refer to it as the payback period, which is how much does a property need to increase in value before you recoup all of those costs that we talked about in terms of the stamp duty and the agency fees and the capital gains tax, and not to mention just the opportunity cost of what else you could have done with that money in the time that it was invested in a property. So you want to make sure that you've got enough cash to be able to hold the asset for long enough to ideally be able to recoup all those costs, but ideally generate wealth above that.
And what's the next step for the Colley portfolio?
So we've just refinanced the commercial loan and our resi loans as well, because they've increased in value. We're now able to get better rates and terms, with LVRs below 80%. So that it's been the first time that we've done that and not geared the assets up to be able to buy more property. So it feels a little bit different compared to what we've done in the past. But for right now, we'll consolidate. As I mentioned, we're growing our family, and that's been a focus over the past 18 months, and will continue to be over the next likely 2 years while our kids are little. And then there'll come a time where as the assets increase in value further, we'll end up with what I would call lazy equity in the properties. And at that point in time, say if the LVRs were to drop to say 60%, I will then be looking to get that portion of equity that's new to be able to put into a further asset to grow the portfolio.
Awesome. Yeah, the twins will take a bit of focus in the meantime, as such as they should.
Yeah, definitely. And that'll be the priority. I mean, and that's for us in terms of what motivates and drives my wife Sally and I. Like it's mostly related to family and experiences. I have, strong desires to want to pass down lessons and kind of capital to our kids as they get older, to help them, be in a position, when they're looking to purchase houses, which, who knows how expensive they'll be in 2 decades time. But also mostly to pass on the lessons around how to use capital to generate wealth, as opposed to, your own blood and sweat and tears.
Yeah, awesome. Well, Brendan, I have to say, congratulations on the success so far, despite you saying it was a bumpy road. I think you've outperformed the market of property investors by quite some margin and still got a long way to go. So thanks very much for sharing your story and your insights today. Is there anything that you want to leave us with?
I just say to people, be diligent in your preparation in terms of understanding what you can afford, but also at the same time not procrastinating for long enough that you kind of miss those growth periods in the market, where assets change. I feel like I've got a good balance of doing enough work and prep to know what decision we need to make, but also being fast enough to act to get the upside. So pick a good team and trust in the process.
I love that, mate. It's been a pleasure. As I say, congratulations on the success, and we look forward to checking in with you down the track to see how you're going. But thanks for sharing all of those insights today.
Awesome. Thanks for having me, Mike.
Cheers.